Hey everyone, welcome to the Elite Real Estate Podcast. I'm your host, Sam Popple, along with my co-host, William McClellan. How you doing today, Will?
Oh, I'm fired up. I'm fired up. What's happening?
Man, it's a great day. So I love going to big real estate events because that's where you can meet some connections of people that are doing things on a level that you've only dreamed of. And that's kind of what happened whenever I met Nancy, Kitti, and then her sister Palmy over at the Real Estate Summit this past December. So Nancy and Palmy are AKA the Kitti sisters. Built a lot of wealth behind multifamily offices and real estate investors with big dreams. They have nearly over 500 million in assets. They didn't just start here. They came from the fashion industry and went through a bunch of setbacks, but they were focused on the right systems, strong partnerships, and disciplined execution. And that's how they built their portfolio. And they are passionate about showing others how to move from earned income to owned income and how to scale it multi-generational wealth, along with how to legally pay less in taxes. So over 100 million saved so far. I can't wait. So without further ado, welcome to the show, Palmy and Nancy, aka the
Kitti. Yay!
What up? What up?
Hey, thanks for having us.
Oh my gosh. Thanks so much for being on. This is going to be a lot of fun. I can't wait to hop in. We've got new construction. We've got your learning about your story, how to legally, save a lot on taxes. I mean, there's a lot to punch through and get in this session. So, I'm ready. You guys ready?
Yeah, we're super ready.
All right, let's go. Sam, you want to start us off?
Yeah. So for listeners that are meeting you for the first time, tell us, who are the Kitti sisters?
Yeah.
So this is Palmy and I'm Nancy. Like you said, together we make the Kitti sisters. Today we co-own and operate nearly $500 million in real estate and alternative investments. We partner with high net worth individuals, business owners, founders, and multi-family offices to help them build wealth that lasts, not just for this generation, but for the next one. But the simplest way to describe us is we are the infrastructure behind wealth that lasts. We help people move from earned income to own income and then to institutional ownership, right?
Well, I don't have anything else to add. We also like drinking boba.
Who doesn't like boba? I love boba. So how exactly are you guys structuring these deals and going from earned to owned income? And what does that mean for some of the listeners that might be out there like, oh, that sounds cool, but I don't know exactly what that means?
Yeah, I think that's a really, really good question. And one that really all of us confront, because when we were in the fashion business, we were focused on earned income, which basically means that you're trading time for your money. You have to put in your labor, even if it's sitting behind a chair or you're out doing like HVAC repairs. You're actually physically giving up time for your money. So that's directly now earned income. W-2, you can be a boss, you can own a company, but you're working for it. Where own income means that you own assets that actually produces the wealth, so that you are now separated. Your time is now separated from the income generation that happens. A lot of us, when we get started, because of the school system, because of how our societies are structured, we don't know that own income is a possibility. So we go through school and we think, hey, get good grades, go and find a good job, stick your head in the sand, is work hard. And then in 30 to 40 years, you retire with a golden watch. And then that's retirement. You get to have fun. But 2026, that reality is it's long gone. That's like grandpa's generation. Like that doesn't exist today. Mm-hmm. Even if you have high income, you see what's happening with AI and all the tech workers. Some people say 30 to 40% have already been laid off. I don't know the exact number, but it's a lot of people. And they were earning $400,000, $500,000 and they're not safe. But what's safe today is owning things that can contribute to your income without you being there. And there's many things you can pick, but for us, we chose multifamily real estate. And the reason we chose it was very strategic. It wasn't just like haphazard. The reason we chose it is because at its purest form, it's a machine that serves a basic human need, which is shelter, and it just generates cash flow. if you put money in any other assets, even if you put it into precious metals, which I'm not saying like don't invest in anything else, but the comparison is you put it in things that don't generate income, you have to sell it. You have to sell your gold bar in order for it to make money. Where we right now, I was amazed. I was just getting a report from one of my properties. Right now, our rent on a 3-bedroom is like $2,089 in Georgia. When we bought it, it was like in Atlanta, Georgia. When we bought it, it was like $1,200. Wow. This was like 4 years ago. So it's pretty amazing how much rent can increase per unit in a given time. So yeah, so long-winded, but basically that's what we define as.
And I gotta pause you on that one asset. I think this is too cool not to bring up for everybody listening. So that one asset in Georgia, how many apartments units was that one?
That one's 222. It's 244.
244.
244 units. Increased by roughly $800. Like I'm just doing some, rounded math. Yeah, but 200 units by $800. Roughly, what did that change the value of that asset by?
Oh my God, we need to bring our trusted calculator.
Yeah.
So for those of you, the value of commercial real estate is NOI divided by NOI divided by cap rate.
So basically, I'm not saying we raise rent $800 per unit across everyone, but let's for sake of simplicity, if we did the math, 800 units times 244 times 12 months, that's $2.3 million. Let's double check that. $800.
Yeah, it's like almost $200,000 difference a month.
Divided by
and then pure building valuation changed by over $2 million.
Yeah.
And I just wanted everybody to catch that because that is the beauty of commercial real estate, and especially in multifamily, because you get that small rent bump, but you have 100+ units, you can change some big numbers.
Sam, what's your favorite thing that Grant says? Only $50 can do what?
Yeah, 50. All it takes is a $50 rent increase to change the building by $1 million. Let me give you
an easy example.
So, yeah, go ahead.
So in our property in Rogers, Arkansas, we're looking to do like Tesla supercharger stations, right? So the supercharger station on average is one station makes about $2,500 to $3,000 per month in income. One station, supercharged station. Wow. So the context is this is a mixed use apartment. We have high-end coffee shop, we have sushi, we even have like nail salon, crypto, cryogenic lab, bank. So we have like a mixed use place. So it makes sense. So that one, if we install 6 supercharged station, so we'll just do the math together on that. So it's
3,000, 18 grand.
So 18 grand per month, right? And then let's do times 12, and then let's do a cap of 5. That's like a $4 million increase in valuation.
By adding 6 superchargers. And that's really interesting.
And that's just some other income. Like that's not even in the main stuff. That's the bonus money when you look at a big commercial apartment deal.
And that's like the other income part where like I think most people haven't looked at. Tesla was like, I haven't seen many people put supercharged station on their apartments, and it has to make sense. But in this case, it's like it makes total sense. You get the cap X is around 200K, 250K, something like that. So you're gonna pay it off in about a year plus, but you have a $4 million plus valuation increase. And I think
that's the bigger key there.
Now, before we dive too far into this, I do want to figure out this transition. How'd y'all go from the fashion industry to real estate? Like we've got to start there, and then we can move on.
Yeah, I do want to hear the story.
You're right. So we started in fashion, and we have nothing to do with finance. And we were working hard, like earning good money and doing everything we were told to do. But
where was this?
In Los Angeles.
It's Los Angeles.
Okay, so you were in LA. So you're in the fashion capital, right? There in New York. So you guys are in the thick of it, right?
Yeah. Okay. So but here's the thing: when you make a lot of good money, what no one told us was that, hey, once you make money, you have to buy assets. So for us, what did we do? As a normal people who make a lot of money, you either reinvest into the business or you buy liabilities. And at that time, we didn't know the difference between assets or liability. And one of the biggest lessons we learned was that just one evening, we heard a news that our client decided to shut down all their retail store. So just like that, like overnight, we lost over 95% of our income. So what we learned is business can change overnight. The algorithm can change, the tariff can happen, wars can happen, or even the macro economy can shift. And then one day we experienced that like on our like the first hand, right?
Yeah.
Mom?
So basically, like we were in the fashion business, have absolutely no connection to real estate, never even thought about getting into real estate. And it happened because we were forced to. It wasn't it's one of the best things that's ever happened to us. But at the time, it felt really horrible because imagine going from spending money like there's no tomorrow, and then all of a sudden like realizing it's not coming anymore.
Yes,
it's not coming.
I absolutely hate budgeting, so yeah, I get it.
Exactly. So,
yeah,
like just buy stuff and to go from that, and like we're responsible for like an extended family. Like we take care of parents, grandparents. So it's like if we have no income, it's not just two people who don't have income. It's like an extended amount of people who like now how are they going to survive? So it actually forced us to rethink everything. Then we realized what we had wasn't an income problem. We have a structure problem, meaning that our income depends on our business and our business depend on our clients, right? Business.
And our clients depends on forces we couldn't control. That's when we understood something that changed the direction of our life is that income that depends on your time or someone else's decisions is super fragile.
Yeah. So we had no choice and we had to get into real estate. We started flipping a few houses in Los Angeles and we were doing good. It was fine.
What years were these? Just for the listeners?
2017.
Okay. Sweet.
Yeah. So it was good timing to do.
So you've done all of this in less than a decade. I just like I like to highlight that because one, that's insane and I love it.
So
Two, it's crazy inspiring, and I'm hoping that we can do the same thing. But
yes, our first apartment was actually 2019.
Oh wow. Okay.
August.
So what kind of properties were you guys flipping in 2017?
So we were buying so context is Los Angeles. So we were buying like the first one was like 500, 600,000 and we were selling 700,000 and we were selling for $1 million plus. So you were net like 100+ K per house, basically, if not more. But the problem was when you guys have experience with like the production side, so you know, like it's terrible to deal with the city. Florida is easier, but like in Los Angeles, the city of Los Angeles or some other cities, their inspectors will change them, right? So like one day they'll come in and they'll approve, do this. The next time someone else comes in, they literally tell you to do the opposite. And I was tired of dealing with the city. We had to wait for permits. The delay cost a lot of money. We were using hard money lenders. So
it wasn't glamorous at all.
It was
like the reason I'm smiling laughing is because Will and I were talking about this exact same scenario yesterday at one of our deals about how we submitted two of the exact same house plans, and the second time they had is it 5 times as many edits as the first one?
Yeah. We had 12 changes from the last approved change from the 2 identical houses, and I'm like, we're already halfway building this one, and everything was approved. How are we about to start another one? Took all of your updates, and now you have 12 more updates. I had to go down there. I'm like, this is ridiculous. Like, where are the rules? And they're like,
that anywhere. I'm sure LA is even worse though, because I've heard California is one of the worst states to try to build in. So I can only imagine. But I was laughing because I was total agreement on the pain.
Because you would think about it, right? Like the people say, hey, building home builders, we're the bad guys for making the prices high, right? No, it's the inefficiency in the system that's making the prices high. It's the zoning laws. It's like you can't build more density. You look at what you have to go through. Like the fact that you have 2 identical homes and you're having basically 2 different plan approval process. That is the reason. Like these things should be like this. I don't know. Like I'm not saying like China has like the safest standards, but you hear stories about like they build like a whole hospital in a weekend. right? Because I'm not saying like go to those hospitals. I don't know if it's gonna be safe, but basically like can you imagine like somewhere in between, some middle ground where there's common sense things that should be figured out in the age of AI versus having some manual person like I'm moody today or like, oh, I'm gonna add this. Oh, I think maybe like why? All those things are inefficiencies that every
Jeff
day you're doing
Bezos actually recently brought up because of his own trying to get through building codes. I think down in South Florida, and he said why isn't there AI already set up that can approve or deny within 30 seconds of submitting with all the things you need to correct. So I think a lot of people in the building industry fully agree with you, including us.
And that's how we got started in commercial real estate, through like flipping, because we were asked to actually become like passive investors in like a real estate syndication deal. And at that time, we have no idea what that was, right? And we heard, like, we sat through like a webinar, like investment opportunity webinar, and we realized, oh my goodness, that's exactly what we wanted, because we didn't want to be landlords, but we still want to participate in the upside of hard asset. And we didn't know how to operate like the apartments. We just want to
deploy our money.
Yeah, like create that, scale our own income. That was the reason why and how we got started in commercial real estate. And once we start doing a lot of like passive investment stuff, then we realized, okay, we want to cross over and do the active side, where we are like putting together deals and helping people truly scale their own income.
Yeah, and so when you guys talk about large deals, I think part of the reason why it wasn't hard for us to just buy larger apartments is because we started investing passively in large apartments.
Sure.
So the first apartment we invested in, I think it was like 200 or 300 units. So when you have like, okay, other people are doing that, it's multifamily real estate is a very simple business. You increase income and you reduce expenses. Now, how you go about doing that can be kind of complex. But the business model is very simple. And so when we look at, okay, this guy sounds like this syndicator, he has a good track record. We trust what he's saying. It makes common sense. And he's able to operate 200. And as we started investing in more, we felt, well, we can do what he's doing. And that's how we got into doing it, where we become not just the passive side, but we're the active people who raise the money, put the deal
here's
together.
The thing, like, we always advocate of like partnerships. So we wouldn't
don't do it.
Yeah, we wouldn't tell people who never done it themselves, like to just go out and buy an apartment
by yourself
and operate on your own. Like, because I think that's scary.
Yeah.
That is scary. Now you're saying Atlanta, Arkansas, you started living in LA. So tell the listeners a little bit about national investing and how, I'm going back to exactly what you're saying. The business model is simple. The application is the hard part. Of course, raising the capital is really tough. But why are some of these deals more attractive than ones closer home?
Where are you guys based out of? Let's actually start there.
Yeah, Los Angeles. We don't have any real estate in California at all.
Well, because when I was talking to Nancy at the summit, you guys were doing a lot of ground up building in Dallas area. Yeah. I think it was like around, correct me if I'm wrong, it was, I think 100 single family homes to sell, and then like 100 plus townhomes to keep as rentals. Okay.
Yes. So we have so we started buying multifamily apartments. So we started in Phoenix. Our first one was 76 units, 6.9 million purchase price. And we've gone all the way up to 77 million purchase price. So we have a lot of properties that we bought and sold in Dallas, Metroplex, Dallas Fort Worth. We have Houston, we have Arkansas, we have in Atlanta, and we're building exactly what Sam said. So right now we're actually in a lease up phase for our build to rent community. Those are 118 townhomes. Right now we have 16 units built online, and we have 11 of them leased as of yesterday. And then so that's, and then the other side, we're building the single family homes. Those are not, we just finished a horizontal, so we're waiting for the city to give us the street address, street number, so we can start doing the vertical. So the premise behind build to rent and build to sell, and you guys will appreciate this, is that dirt is cheaper than buildings. So
buying existing buildings.
So when we buy dirt in the right area, and when you buy dirt, you're not buying it and it has income producing day one. It takes 2 to 3 years, maybe 4 years, from dirt to horizontal, to getting entitlement, to getting the engineering plans approved, to building, to doing horizontal, then vertical construction, and then lease up, right? So for our build to rent, we're in it for the long haul. We want to buy something that we can hold on to. It's hard to win deals, and if we know the ins and out of that property, I'm tired of selling it quickly and not benefiting from it long term. That strategy will probably hold it for 10 plus year, and it's going to be a refinance into like infinite return model where when we finish leasing up, we'll do a cash out refinance into from construction to permanent financing.
Mhm.
And then from there, every couple years, if it makes sense, we'll continue to do cash out refinancing. In this sense, the investors will have less and less of their principal in the deal, but still continue to get the cash flow from it. And so we have multiple strategy on the build to sell side. We're building single family homes and we're selling them, but we're doing it in phases. So first phase is 17 homes, and even within that, there's like 4, and so we're doing both. I don't know.
I love it. Now you guys emphasize the systems, partnerships, and discipline execution. Why are those pillars? Why are those the pillars of your success?
Because wealth doesn't scale on effort, right? It scales on system. So effort is personal. Systems are repeatable. And when you combine system with strong partnerships and discipline execution, you create durability.
Yeah, because if you do something once and then it's not programmatic, like you can't repeat it again over and over, you lose efficiency, and then you end up actually having to repeat everything over and over again.
And that's how we were able to grow from like a $2,000 bank account to nearly $500 million in under a decade.
Yeah,
right.
Like it has to do with like understanding, having a really good focus on what you're going to invest in, and not be distracted because there's so many shiny objects out there. We do right now things that is related to real estate. So multifamily, private credit that lends money to real estate, the build to rent development, like building construction, the single family homes. So we're not trying to be everything to everyone. We want to grow, but I think we're going to do it in a very cautious way where we're planning it out. And so that's kind of like the mindset that we have. How we select partnerships, that has to be a set criteria. It's not, we are approached every day to join deals, to be part of a deal, or people ask us, hey, can you come in and be part of our deal? We would love to say yes to everyone, but it doesn't make sense to do that, right? Because like there's a lot of things in the 7+ year. What we realize is we grew fast because we were in the right partnership. And so if we didn't have those right partnerships, we wouldn't have grown this fast. But we also recognize, since the 11 interest rate hikes, since all this stuff has happened, who are the partners who not only are good character, who are going to stand with you when the deals are tough. When we've had fires, we had multiple fires on one property. We dealt with a lot of different things. We just refinanced a deal that took like 2 years to complete. But all those things prove to me, like, who are the people who not only have the good integrity, who's like, I'm going to stand for my investor, I'm going to do what I can, but also know what to do, have the experience and like the cleverness to actually get it done. I think those are important.
And then I think if we didn't have good partners, we wouldn't be able to scale, because if fires happen in one of the apartment, that's probably going to be our focus. But because we have partners, so we were able to do the refinancing, like $24.75 million, and then still building the 105 single family homes, and then still leasing up 118 townhomes, and then
everything is still moving. Like, well, we're focusing on, of course, the refinancing was very critical, so we had to put a lot of attention, but nothing else fell off the wheel. Like, that's the most important part.
And I think that the important part was, at the beginning, we didn't want to do partners, like have partnership. We were just like normal people who want the whole control, like, because we didn't know what to do or who to trust. But like in multifamily, it's truly a team sport. And we learned the hard way that not all partnerships are equal.
Sure.
Definitely.
Yeah. Now, I am really curious on building and finding these partners, and then how you're able to do all of this remotely. Like, how
And
often are you in Dallas?
yeah, and identifying the right partners.
And then how do you know, like, if you're
So
doing a tens of millions of dollars of projects from build to rent and build to sell,
yeah.
and you guys are halfway across the country. Luckily, Dallas is slap in the middle of the country, which is nice. But still, I mean, to me, that's nerve wracking. Like,
So
I
there's
hear everyone's like, "Hey, you're in Florida. Florida's great. We still like Texas, especially on the multifamily side." And
so
it makes sense. There's metros: Houston, Dallas, Austin, San Antonio. You've got all these huge metros, and there's tons of people. It's the largest state in the continental U.S., so it makes sense. There's oil. There's a lot of industry, a lot of things that are moving through there. A ton of so I get the attraction, but how are you finding the partners and then being able to run everything from the computer?
So there's two paths, right? You can go the slow route, which is like try to do like, like find partner and talk to as many people and just test and just guess. Or you can do the faster path, which like we started with like investing with them as a passive investors, because that's how you actually know how they operate real deal. And on top of that, when you want to partner with really, really experienced people, you have to learn how to get in front of them. And there are
Right.
many ways to get in front of them. You can, invest with them.
I would say the easiest way to get in front of anyone is to invest with them.
Yeah.
You will get their
Sure.
time.
Right? Because that's like that. Then you have a seat at the table, and as per that opportunity, imagine like really awesome rock star operators. They don't need you to be on their team. You need them, but how do you get in front of them? It's the matter. You can either, like Palm said, invest with them, or you can bring value to them. Like for example, the Atlanta properties, like our teammate, he was the one who bring us the deal, and we were the one who bring the capital and help him close his first Atlanta deal. So it's not just money, but it's also finding deals, bring that value to your all-star, your rock star partners, and see how you can synergistically work together.
I think like I was thinking about this earlier. I don't know if there's like it's almost like this is, you have to kind of go with your gut instinct on who, like use your judgment on like who this person, because this marriage is like a 5+ year, maybe 10-year marriage.
Right.
Sure.
And sometimes, right? So sometimes you probably spend more time with them than maybe your spouse sometimes, if there's an issue. So the key here is don't rush into the relationship. A lot of people in multifamily, because it's so easy to, hey, you have a deal, let's go. I think like that haste is where people get in trouble. I have a friend who, unfortunately, a couple months back, foreclosed on a property that she raised money for. So it's her investors' money also that was lost. And the reason for that is she partnered with someone, and then she came and told me later that she didn't realize he wasn't in control. He didn't understand what he was doing. Well, that's not acceptable to your investors. Like
Right.
you can't go back and tell them, oh, I didn't know this guy isn't responsible or isn't as experienced, because when you didn't tell me that when you raised money for me. So I think like don't rush, get to know them, talk to them.
And if you can, you do micro investment with them.
Yeah. And like just talk to them, learn who they are, what they're about, and you're gonna pick that up. I don't have like a specific rule, but you guys are partners, and like
how do you guys choose each other?
You know, like there's things about like, okay, do I working style, are the skill sets complementary? Like those are the basic things, but like how do we get along? Because outside of like the tactical, like I need to do this, you do that, but we have to enjoy talking to each other.
Even like for us, like we have raised so many of our investors to become our partner. And that is based on like, because we already know you, like you're in our deal. So we talk to you on a regular basis, and we do a 506B, meaning that we need to have pre-existing relationship before we can take your money. So we really, really know who they are already before like we ask them to partner with us.
Yeah.
Right. Now, what are some of the key systems y'all built that allowed y'all to scale so quickly?
I think probably like go by the triple D, right?
The like this is just basic for us. Like if we're thinking about like, okay, how do we manage have this portfolio across the country, and it's super simple. It's triple D. So basically, first is delete. What are some functions that we're doing today that is a distraction and a waste of time? And that goes back to the shiny object, because hey, one day crypto could be high. Like I remember a friend a couple years ago came and told me he's making tons of money forex trading, and I literally got kind of excited because he was like doubling his money every 2 weeks. And I told Nan like, hey, he got us in, and she was like, no, we're not going to go into that, and he ended up losing all his money in it. But basically, like, don't get distracted by those things. The second thing is delegate. So whenever possible, delegate to the people that you have on your team, because there's some stuff that not only you don't like doing, but you're not good at it. Someone else is better at it, have them work on it. And the third D is dominate. So where you find your core strength and competence, go like 10x on that, and have other people help support other functions.
The last D.
That was the last D. So triple D.
So delete, delegate, dominate.
Yeah.
I love it. I love it. Now, is it okay if I ask, with these deals, let's go to Dallas, and we're going to focus back into the Dallas Metroplex and on the deals for build to rent and build to sell. With your partners there, I mean, if you're doing vertical construction, but now you're having to do all lot preps because you said just got everything prepped for horizontal. So for the listeners, that means they're prepping everything to get a DO, a development order, so that they can turn in, getting all the engineering, prepping everything for site retention, getting everything prepped for city sewer, city water, all utilities, underground utilities, fiber optics, etc. So there's a lot of things that go into that. Now, that's a lot of responsibility that you're not in Dallas. So how did you find a partner for such a large deal? Was that by using those strengths of, I invested in a deal first for someone that's in Dallas, they had a big apartment complex, and then I found this land? Or what kind of morphed this into like such a slam dunk? Because I'm excited. It makes me just want to go fly to Dallas.
So basically, in this specific case,
we've been partners
on like several deals together, and he happens to also be a general contractor. Okay. So therefore, it's very easy for me to trust someone that I know. In this project right now,
the background is we've been buying existing multifamily buildings together, like multiple. On top of that, on the side, he's been doing some construction, but in a smaller scale, like 20 or 30 units. So he needed us at like our help to scale to 118 units, right? So for us, like we are complementary scale in building, like he can build and we can lease it up.
Marketing.
And what I realized is this: building, if you think it's hard, it's not as hard as leasing up. Imagine you have 16 units coming online all at once. What you need is real demand, real desire. And so for us, like we're the people who are responsible of the leasing up phase, meaning that no matter how many units thrown at us, we have to get that lease
and
up.
That's why we don't have to be local. And some of the terms, William, you threw out, I don't even know what they are. But basically, it's being built. Like
right, it's getting done.
All I know is horizontal, we were $400,000 under budget, and so far for vertical, we're about $2.5 million under budget. And we're on.
Well, and you know what else I just realized just from this little bit is that, you know, all those terms Will threw out, he knows them all fluidly. And, you know, you said that guy was building around 30. We're building around 20. I'm just pointing out there's a lot of similarities in what we could use you guys for in the Florida Panhandle.
Just saying.
Yes, and for us, like on build to rent, we're focusing on the leasing because I feel that that's where the money is actually made.
Sure.
Like building is important, but if there's no lease, then there's no money.
So basically, like now we're in the lease up phase, right? So buildings every single month they're coming online, 16 at a time. So we have to make sure we are on pace. Okay,
sure.
This marketing strategy doesn't work. So we have a hybrid strategy. We have AI, digital, and also like analog. Analog, literally, we have a sign spinner, like a sign spinner on the street. We are going all out. Like we're multi-dimensional. We're not going to rely on one type of marketing strategy. So
okay, I got to, for listeners and for my pleasure as well, let's go high level, your top 10 marketing strategies, because I'm loving this right now. You have a sign spinner?
Yeah,
that is amazing.
And we track it. So we have like three 3 tours from it and 1 lease. So that already worked.
We
No
just
way.
We just started it. Yeah.
That's actually,
Let's
I
go
mean, to get
drive
1
around.
lease is worth it right there.
Yeah, we just got to go
But
drive
that's what I'm saying. Like leasing up phase is one of the most critical phase of build to rent because
Oh yeah,
that's
totally.
where money is made.
And like so okay, the sign spinner I recommend. That's like very simple. The other one is like one of the things we're doing right now, and I can't say it's like it's a strategy that we're working on and we haven't fully got it complete, but there's hospitals around the area. And like in May, the new residents come into the area. So if you may have heard on the news, like, hey, tons of residents just got approved, got accepted to certain hospitals. So now they're being deployed. Normally, they don't get deployed to where they studied. So it's like
Sure.
all around the country. So we're working with a hospital and their like placement team so that these people are going to come in like May and June. They'll already have housing. So that's another strategy where you go not corporate leasing, but you work with the like big institutions that's in the area. We have like a special that we have with the daycare nearby where if someone moves into our place, hey, while you're moving in, we're going to pay for your daycare for the day. And there's some like some package that we're offering with them. Big one is we have an AI system that we implemented. So every call that comes in, if a human doesn't answer, a verbal AI, like you call and it's an AI talking to you about like, hey, what are you looking for? Answering the questions and booking. Most important is booking tours.
Mm-hmm.
And that's where there's a human component and also there's a virtual component. So a human is like we have 9 to 8, something like that. Like I think we started maybe 9 to 8 recently. So basically someone goes and tour the property with them, right? That's normal. But then we also have off hour, what's called like self-guided tour. So the AI will give you a pass. So first you have to send your credit card and your ID and we verify that you're the person who's going to be opening the unit because no one's there. And then you go and the AI gives you the code to get in, which is a unique code to you. We have cameras all over the units just to make sure no foul play. You start walking in. As you start walking in, it talks to you and it explains to you like, okay, this is what's happening here. This is all the stuff. And then you can even ask them like, hey, are there any leasing specials? All the way through to filling out the application.
And we have success.
Yeah, and that's actually proven to be a lease up as well. Marketing on all the major ILS, the having different packages, testing out, okay, what are the keywords people are using? What are the ones that make sense? Which tier is too expensive? So digital, like I said, like high level, 3 different things, like analog, like people connected with people in the community, literally having a sign spinner, having digital presence, marketing, paying ads, paying for LIS services, and then having an AI component where we fill in the gap when our leasing team are not available to assist.
Like we're a firm believers of like just because you build it doesn't mean they will come. You actually have to go bring the people to come and get them to lease your property.
Oh yeah, no, I definitely can attest to that. It's hard to find, people like yourself, good property managers and active people that are marketing and getting your product out. I am curious. So did you guys build the AI system or are you using?
No, there's tools out there. We use Lease AI. So it's not even very expensive. So it's been out for a little bit, but there are some tools that are brand new that keeps rolling out. But so that's one of them.
Okay.
So that they do a lot of that. There's other stuff that goes like the locking mechanism is through the ADTs because we have a security system.
Mm-hmm.
Digital marketing, that's just, like I said, it's like a Google AdWords listing on the major platforms and testing which one works because some may not work for.
Right. It's just doing testing and seeing what. Constantly. Just consistently tracking all of that and finding things that are trackable.
The other one that we just started, I don't know how well it's going to go, is mailers. So like we mail out flyers to our competitors. Hey, your leases are expiring. You want to come to our cool brand new place? Yours is.
I love it. Yeah, it's brand new. You're gonna love it. It's awesome. I love that.
That's great. Now, you guys maintain control and clarity very well. At scale, what do you think the biggest key is to doing that, from being remote from most of your properties?
I think like in real estate, there's only a few key KPIs that really tells you the health of the property. So when we look at it, of course, we look at occupancy trends, we look at expense trends, big expenses that are coming up. But really, what you look at is like, what's your NOI and what's your net cash flow? If you can see those two things are trending up or like is on par with what you're budgeted for, then you really don't have to go into detail. I think like when you trust and to delegate to people who are superstars in what they do, you don't have to feel like you have to micromanage. A lot of times, and I was telling an investor this actually right before our call, I told him, I am not going to be on every single meeting with my property management team. I will only be there if there's like a big problem that I need to solve, because there's no point in having me there if everything's running as it's supposed to be.
The system is already operating.
There's someone who's supposed to be there. So
you're paying them to do their job.
Exactly.
It's like Elon Musk doesn't attend all the meetings.
And we cannot grow to this scale. Like our aspiration is to become a $10 billion company. And we can't do that if we're micromanaging like every single lease signing, or like, hey, this check hasn't been collected, or this eviction, or this CapEx. Like we cannot be at that level. So we have to be willing to trust the people we put in place and have tools to check on that.
How are you finding these people and like building that team for?
So a lot of it is through
people on
referrals.
the ground?
It's through referrals. So all the property management teams that we've hired, we do a lot of interviews and we screen. So first we'll ask if we have friends in the area. For example, if I were to buy a property in Jacksonville, Florida, I would reach out to a couple of friends who are doing multifamily out there, and I'll ask them, hey, I'm looking for A-class properties. Who do you recommend for the property management? Or you can also look at the team that's already there and see if they are a good fit, because you can see how well the property is performing. So we always find the right fit. For like lease up, there are certain property management companies who are really strong at leasing up, and there's others who are strong after it's been stabilized. So you cannot mix them. If I
match the asset and the property,
the property management company needs to match the asset, and also geographically, they need to have a lot of properties in your area. The Georgia property we mentioned, the property management company they were out of Florida, so they were like,
that was from the time that we were buying.
When we can be remote, but the property management team cannot be remote. Right. They have to be there, right? So when we bought the property, they were operating it from Florida, and it wasn't doing very well. And so we always make sure they have a large a density of units around our area, so we have market intelligence from them.
Yeah, and they had that thing underpriced by like around $800 on the unit, So I mean, yeah.
And literally the next door, same build. It looks almost identical. So yeah.
Wow. Now I do want to move on to some of the tax strategies. So you've helped save over $100 million in taxes. Totally incredible. Why is tax strategy such a critical part of wealth building?
Yes. So like, that's a really good question, because we're kind of like in tax time round, right? And we were just talking about this because we did a YouTube video recently, and the video Nan was talking about how like when you lose money, the basis gets less, so it takes longer to earn back the difference. And that's the same thing with taxes. I think we should be responsible to pay the taxes that we owe, but given all the fraud scenarios that's happened, lately, California, and now we hear in Minnesota and all these other different places, you start to question, like, am I being responsible by paying taxes, or am I just being a sucker and these people are just ripping me off? So we want to legally, so like right now, all we can say is legally pay what you're owed, but not a cent more. Right. And in the case of multifamily, it's the best vehicle to actually not pay a lot of taxes. The reason we're able to save it's actually $100+ million. It's not even just $100 million. The reason it's that high is because we have bonus depreciation on these multifamily assets. Simply, anything that is not the dirt value is considered something that is depreciated. It's on a depreciation schedule. And then because of bonus depreciation, you get to push all that into year one. So one example, one property we had, someone invested $100,000 because of how much loss was on the property. He got $118,000 in losses.
$142,000.
$142,000 in losses.
Wow.
So he put $100,000 in and got 142,000
In
deduction.
losses.
Well, here's the problem. A lot of people think that taxes are the way of life, that you just simply need to pay and just move on. But what people don't realize is that taxes are basically a series of incentives of what the government want us to do. So the government signals that.
I love that take on. I totally agree with that.
Yeah, because the government signal that, hey, if you help us solve this
Housing.
matter to this matter to the society, will reward you. And the biggest problem that they have is housing, right? They want
affordable housing.
They want us to provide like safe, clean, affordable housing to their citizens, and that's basically what we're doing. Yeah.
No,
And so,
I've used that exact same example on it's what the government wants, and basically taxes is what they do to penalize you when you take the money out of their ecosystem.
Yes.
So yeah, it's yeah, no, all the breaks are for you to keep the money in play for society. You really only get penalized when you want to take it out personally.
So in essence, we're actually partnering with the government and doing what they want us to do.
100%. Yeah. What are some of the biggest tax mistakes you see real estate investors make?
I think like that's also a really good question. So,
well, like I said earlier, because they just think that tax is a way of life.
So that not understanding at the beginning, first round of bonus depreciation coming about, some people didn't even take advantage of it. They didn't understand it, so they didn't do it. I think also the structure, the way you invest in deals is really important. Super simple example: if you have an IRA account and you have the option of keeping it traditional, meaning that you can invest and then you just defer paying the taxes until at the end when you take it out, or if you have a Roth IRA that it's post-tax, meaning any income that you get from it, you don't pay taxes. Like, what's the best option? If you can pay the tax today and then have it grow to like a massive amount.
Because you would hope that that account would grow.
Like Mitch Romney, right? And Peter Thiel, their Roth account has hundreds and hundreds of millions of dollars.
I love Peter Thiel's story. Yeah, I'm very familiar with how he beat tax.
So that's why, like, simply understanding, and not just so. Most people, we have bookkeepers and we have CPAs, and their job is only to prepare taxes. They're just balancing the books. They don't have any knowledge of high tax strategy knowledge. They don't understand any of this. So the other mistake, not only is structural, but hiring the wrong people. Mm-hmm. We used to pay a lot in taxes because we were like told that, hey, in fashion, right? We were like, hey, you have to pay this high tax, otherwise
there's no investment.
There's nothing that you can do to reduce your tax burden. But when you talk to the right CPA and the tax strategist, you shouldn't go to them and tell them, hey, Palmy and Nancy mentioned bonus depreciation. You should have them tell you, what are the things that I can do now to reduce taxes?
What can I invest
in?
So
it's like structurally, but also having the right people on your team to actually give you those advice is important.
No, that is great advice. And I definitely think too many people go to a CPA to prepare their taxes.
Yes.
To just to file them and not asking them like, hey, how can we or basically even talking to them like, and 6 months before the year's out, like, hey, it's June. What do I need to do over these next 6 months to make it so I don't have a big tax burden in 2027? Like what, I definitely agree with that. Now, how early should investors start thinking about tax strategy?
Well, for us, it's as soon as they start making earned income, because that's when they need to start thinking about tax strategy, because making money is one skill set, but keeping it is completely different skill set.
If you think about the analogy of a pail, and the pail has holes in it, no matter how much water you try to get into it, it starts leaking out. And if you're really intent on having generational wealth, and you're allowing the pail to be leaking from because of the tax burden that you're paying, then you're never going to have that generational wealth. There's like, you can have small leaks, pay what you should pay in taxes, again, not a penny more. So if the switch is only from traditional to Roth IRA, or investing and having bonus appreciation, and like they're minor technical tweaks, not actually doing anything really different for you, then you really need to do that like day one. Robert Kiyosaki talks about the four quadrant of income. W-2 workers and small business owners are the two groups that pay the most in taxes.
Yeah.
So therefore, you have to get yourself to the, in our case, like the B, which is like 500 employee or more, or better than that, the investor side, which pays very little to no taxes.
Now, you did talk about getting to that generational wealth, and you love talking about building wealth that lasts. What does that actually mean?
When you look at like the biology of human beings and any animal, you see like their purpose is to continue to the next generation. It's biologically hardwired into our DNA. And when we see the shirtless to shirtless in 3 generations, that's happening because not only, most importantly, is because they didn't structure their wealth correctly. They didn't have the governance, they didn't have the education, they didn't talk to their kids about money. And that's why it's not because they were lazy, it's not just because they're entitled, it's because they didn't understand how to actually manage wealth when your parents have money and all of a sudden you never have a conversation with them and you expect them to survive. We talk about this, like, in my opinion, if you have wealth, you need to start actually, the inheritance needs to happen before you pass away. Like, hey, Sam, here's your cut right now. I'm alive. I can help guide you through this.
And you help build the system that survived
without
you, right?
Yeah, like have those conversations. One of our friends was like, we were talking because he's starting to do his trust, his family trust, and he's explaining all this stuff. And I was talking to him and he said, yeah, that's a problem, Pommy. I don't want him to know what he's going to get. And I'm like, your son's a grown man who's married. He's like 26, 27. You can talk to him. If you don't think he's ready to talk to you now about what he's going to get when you're alive, imagine how it's going to be when you're not here to help guide him.
Yes, because wealth that depends on one person is fragile. Wealth that depends on system is durable.
Yeah.
Yeah, no, I agree. I think that understanding the right time and kind of backtracking there of knowing when you need to use a CPA versus a tax strategist or a tax attorney.
Yeah.
That's something that I've kind of been diving into a lot more in the last 2 years. And I've been trying to self-educate as well as listening and getting on as many calls as I can to try and feel that out, because it is kind of a partnership. And if you find that right person, you'll have them in longevity, hopefully. And the idea would be to pay, like you said, as little as
legally, ethically, and morally.
Right, legally, ethically, exactly.
A good accountant will save you money when you pay them.
I think they always say like a good accountant you don't ask a good accountant, is this okay? Can I do this? You ask them, how can I do this?
Right?
Yeah. And my other favorite accountant saying is if you ever get audited and you don't owe the IRS money, did your accountant really save you anything?
But I don't know that one, but
I want them to audit all those fraudsters. I feel like it's pretty easy. Like stop bothering us. We'll audit the real people who are stealing money.
Exactly. I completely agree. I think that there's a level here for people to get super excited. One, you guys have done it so much in a decade that I am really so thrilled that you guys gave us some time today, and I got to virtually meet you all and kind of pick your brain through some things, because this is just firing me up. I'm so excited. Two, I kind of want to understand, in closing, how you're able to partner, how you're able to get to the table to invest in some of these deals, and then how you're able to find these deals to then bring people that you early invested in, and then I'll bring them to the table where you're maybe like a general partner versus a limited partner or something like that.
A lot of, okay, so there's a
lot. It was loaded. We'll just start on like, how do you get to these, investment opportunities?
Yeah, I think like right now there's a little bit less, right? The deal flow isn't as there aren't as many deals as before. Now we're in a really unique period of time. Right now, there's a lot of deals like we refinanced. We were very lucky we were able to. Grant had 2 deals he announced recently that he couldn't refinance. Now Grant has probably didn't, those deals weren't in trouble. So it wasn't a problem. He didn't refinance. There's people right now who didn't refinance and now they're in trouble. And so this is a unique opportunity where the prices are depressed, but we know there's upside. That's where you have to have relationships with broker. Real estate is a relationship business. It's not about you going to telling them you have money. It's about them believing that you have money and knowing that you can close on the deal.
And close the deal.
Execution certainty is everything. When we bought our $77 million property, we've never raised $39.4 million before.
And that was what we raised for that deal.
Yeah. But the broker had to believe that we could.
Right.
Hello, brokers.
Thank you.
Now, how are you getting?
How'd you convince
building a relationship with so many brokers? Like, let's say you're in LA.
Yeah,
how are you finding these brokers in Dallas?
So it's actually
Arkansas.
like one deal at a time.
Okay.
We didn't always have it. We didn't have the track record when we first got started. So we kind of partnered with someone who the brokers would call them back, because that was really
was the first step.
The biggest issue we had, because nobody took our calls. Like, we tried to call during hours after hours, they just didn't call us back. And then one day, like, we got smart and it's like, oh, like, maybe we can partner with someone who actually can talk to the brokers. And that's how, like, one deal kind of lead to the next, because when you partner and when you're in these deals, the brokers know who you are. So when you're looking for our next deal, you call them and say, hey, I'm interested in this property and I just closed on this deal with you guys here like 2 months ago. And that's how you start building that relationship with the brokers.
There's not that many brokerages that handle multifamily apartments, right? So there's like literally there's 5 maximum in any market that's like a real player. So Marcus, Millichap, Newmark, Northmark, CBRE, stuff like that, right? There's just the same people over and over. If you do a transaction in one city with their broker, they'll know the guy in the other city. And if you're someone who was easy to work with, you execute it, they'll put in a good word. Like, that's how it is.
That's how we won our Arkansas property.
Yeah.
Because
Rogers, Arkansas is like in comparison to Atlanta, Dallas Metro, and other places you're investing in, that's kind of a small subsidiary market, right?
Yeah, and they weren't even there. I think they're from Memphis. Like, the brokerages, because it's not that big. But basically, like, so we closed on a deal in Houston with the same brokerage.
Where we raised $34 million. And then 4 months later, we make an offer in this Rogers, Arkansas. So we asked the Houston broker to call their Arkansas, which is Memphis office, and vouch for us that, hey, we're easy to work with. And we just closed, like, we just raised $34 million. Here's the $39.4 million. They can do it.
Yeah. So it's a relationship business. It takes a little time, but it doesn't take that long. You execute on one deal. Now they know you. Now we have deals that we're going to sell. So now we become important to them.
Sure, because they want to make money on both ends.
Yeah. So every call they make is valuable. So you have to understand where they're coming from and position yourself in a space where they need you.
Yeah, I have 2 questions. This is kind of help newer people, and one of them is to actually help women specific. So my first question is just newer people in general. When a broker wants to know if you're serious or not, they usually ask you for proof of funds. How did you get around that initial proof of funds question on the first deal?
You know what? When it's a big
Our
deal,
secret, they didn't ask for us.
Yeah.
Okay. Yeah.
When you work on big deals, that's not what they ask. So they know we're gonna raise money through syndication. So this is how it works with syndications. When you submit your LOI, your letter of intent, and if it gets accepted, on there you're gonna write like how much earnest deposit you're gonna put in. It could be as little as 1%. It could be a couple $100K. It could be $1 million, depending on whatever
on your deal size.
The caveat is, in the past, that has been non-refundable. So be careful what you put in there, because there's very few reasons why, outside of fraud, that you can get it back. So be very careful. So know that you have the money to put into that, and also know that you've accounted for everything that could be unknown, so that you stay in the deal.
And you shouldn't be talking to brokers if you're not serious in closing deals with them, because that's where you ruin the relationship.
And so once you put in the earnest money, which like for Houston, I think it was almost like $1 million. So when you put in that kind of money, they know you're serious.
Mhm.
And yes, we do not have $39 million in the bank.
34, yeah.
39.4 million. We didn't have
Houston,
it.
that was 34.
But we, because of our track record, we explained that we're going to raise this money, and they know we're going to lose $1 million if we can't raise it.
Right.
There's a really big incentive for us to close. So with that, with getting the insurance from other people that like, hey, we are good for this, they just trust us. So smaller deals, that's always a problem. You have to have like a proof of funds, but big deals, we've never.
And I want to explain like why we love big deals, because like not a lot of people have access to these institutional grade type of deal. And for us, we're fortunate to close on many of them. And that is also through partnership. But at the same time, it allows us to deliver for our investors the return that they're looking for. Because if you can imagine, like, if your deals are scalable, it means that you can hit that, most likely will hit that projected return for our investors in a Class A, safe, and sound neighborhood.
I love it. Now, my other
because you're getting institutional sized deals, right?
Yeah.
And so it's like now you're giving access to people that you're partnering with at a, let's say, more of a local or peer-to-peer network.
Even people who invested with us as limited partners, they want access to those kind of deals.
Sure. I want access to that.
Yes.
Yeah. Now, my other question I was going to ask you, you actually brought it to my attention whenever you would mention how people weren't giving you a call back at first. And shout out to Grant Cardone. Love his real estate summits. I've actually been to a couple of them, and he said this a few different times. And y'all said he said that. And I want to kind of preface it because I don't want anyone to think this is my opinion, because you guys are some of the most successful people we have had on this show, bar none. And so I'm very excited. Like I said, kudos to you. You guys are my heroes. But Grant said that this business, real estate, especially syndicate, is dominated by white males. You clearly aren't. And he actually even said it at the December summit, and I actually heard him say it at a previous one, that if you're a foreign woman, you probably should get a white male to partner with to get on the phone for you, because you will get more callbacks and stuff. I don't know who your partner was you got to get on the phone, but how important is that? Because I want to point out how successful y'all have been, and I want to know, how did y'all work your way around it?
Oh my God, thank you. Because I was just meeting with my friends, and they actually say pretty much the same thing. They're like, you're a woman, you're not white, and you're tiny. Like, look at you. Like, how do you even have the seat at the table? And I was like, what?
And I want to point out to everyone that I'm asking this question because I want everyone to know that success is possible for everybody.
Anyone. Yeah,
anyone can do it. And like I said, y'all are breaking all the stereotypes. So yeah, floor is yours. Tell us.
Like, I didn't realize that was an issue. I didn't know. I think for at least for the Dallas market, because there's a lot of
foreign people,
a lot of Asian investors who are already buying, so they paved the way. Maybe it could have been a problem. Now most brokers are white male. Like, that's even most of our investors are white male. Like, it just happens to be that way. Statistically, they're like 55-year-old white male. I'm not sure exactly.
Yeah, I'm not saying it's bad, good things. Statistics are statistics,
Yeah, but for me, I feel like brokers are capitalists, and they really care about money. They really care about their money. And so they weren't picking up our calls, not because they knew who we were, but because they just didn't want to waste their time with us.
Right.
And the minute we can convince them that their time with us equals to money, that's when everything flipped. That's when they'll give you the time of day. When you buy an apartment, typically it's not a legal binding agreement, but it's like a wink, wink. We're going to sell it through their same firm, right? So Sam sold me this property. 5 years later, I'm going to sell it. Hey, Sam, help me list it. So Sam's going to make maybe almost $1 million from just transacting multiple times with us, maybe even more, right? So you don't care what I look like. You just care that I'm going to make.
You're going to close the deal. And
so the most important thing is like, do not let that become your excuse to not succeed. Because I think, like I said, I don't know about others' field, but in this specific business, in the markets that I'm in, they just love money, and what they see is not the color of your skin; they just see the green in the bill. And so all they care about is like, I'm gonna buy a lot of deals from you. We're gonna make a lot of money together, and you're gonna answer my call.
And then like we don't.
I like it.
Of any industry that create this level playing field that, like you said, we're Asian, we're female, and we're tiny,
and so we don't have any connection to real estate.
Yeah, we have no background. We didn't have wealthy connection or anything. But multifamily is the only industry that we know that create that level playing field. And once you have one success and you keep on building after one another, the broker comes to you. Right? Yeah. They come to you, they want you to buy the deals. You get first access, and that's why we say we have deals. We have access to deals that maybe some of you have never seen it, right? And many of them like are off-market deals.
Yeah.
That's awesome. That's awesome. Is there a specific metro that you guys are hyper fixated on outside of Dallas? I know you guys are building ground up there, but
we try to go out. We try to go anywhere in the Sun Belt that has high growth. Okay. So like landlord friendly, obviously. Try to go to areas where insurance isn't going to be a factor as much.
I thought we were working, and then we lost it with the insurance. I'm just joking. With the Florida's obviously.
No, I heard that it's coming down a bit.
It is coming down. Yeah, no, actually, I got one of my restaurants. I have a big policy that went up for the past 3 years. This is my first year it dipped down.
Yeah, so we had that issue in Atlanta and also in Texas as well, and it's come down quite a bit actually, because we haven't had like major like natural disasters. Primarily really high growth market. Like you guys mentioned earlier, like the reason we like Dallas is because it has so many different industries that really balance itself out if there's issues, especially with A-class properties. But we want like, hidden gems. The reason we bought Rogers, Arkansas is because at the time no one knew what it was.
But it's just 7 miles from the Walmart headquarters.
Like I didn't even want to invest. I'm like, I've never been to Arkansas. Why are we talking about this? Like literally I was offended that this was brought to me. I'm like, what's happening? And then and then it turns out to be basically one of the best properties we have in our portfolio.
And the median income there was like $180,000.
Yeah, there's people. Yeah. The townhomes behind us are like $1 million plus. Because this is and we didn't know this. So basically, Walmart headquarters is a few miles away.
In Bentonville, right?
Bentonville. Yeah. And so Walmart has a policy that requires all their vendors, the big vendors, to have offices in the area. So everyone from Nike to Clorox to Kellogg to whatever brand sells stuff to them, they have to have a local presence. So there's all these people coming from a lot of transplants. Some don't stay forever, so that's why they rent high-end apartments.
And that's why we were able to raise $39.4 million in like 2 months in
Arkansas.
Because everybody wanted that access to that type of deal that we got.
Yeah, I think we can't even buy it now.
On top of that, we bought it in like June, like close July 2023, where interest rate height was climbing, and we got that deal for a fixed interest rate at 3.49%.
Oh my gosh!
8 years of amortization left.
Wow.
So our deals, like compared to other people's deal, we may have like a 2x in 5 years return. But if you can see like the type of asset we have assets to, it's quite different.
Yeah.
Did you assume that from the previous? Is that how that happened? Or
so it was a HUD loan.
Sure.
The builder, it's a construction loan that the builder had. So at the time, I think the construction started 21 or something like that. So when we bought it, there was 38 years left, and we assumed it took forever. It was very long, but basically, it's very difficult to get HUD loans done. Like if you had one piece of paper missing, they'll send back the whole folder. Very difficult. So you have to have a really good consultant that walks you through that process.
Again, partnership.
Yeah. So we pick the right people.
And partnership for us is not just people like us. It's also lawyers, vendors, accounting teams, property management team as well.
And that in this specific case, and I didn't know this at the time. I thought he was a consultant. He was actually doing the seller a favor. So he's experienced with HUD. He was the one who helped them get that HUD loan. So he was basically helping make sure that we got everything completed. So if it's rejected, it's not because it's our fault from HUD, right? So if it's
Got
an
it.
issue, so found out like, oh, okay, so he was, because we tried to pay him, he wouldn't take our money. So I was like, what's going
Wow.
on? So he found it.
Yes, and the seller was simple. She wants this deal closed.
Yeah.
I love it. No, so in those types of things, are those deals that you're currently keeping your eyes out for assumable loans? Because I know a lot of people refinance, and you mentioned that a little bit. A lot of people in like large multifamily. We just had another guest, Austin Tiefke, right? Or Matt Tiefke, and
Matthew Tiki,
yeah, and sorry, he lives in Austin and invests in Austin, San Antonio, and does a lot of multifamily deals there. He was saying the same type of thing. He's like getting in with all of the brokers, understanding, but they were looking at the point where a lot of people refinance at the incorrect time, and by doing that, there's a lot of open deals right now. Like you were mentioning, that there's a lot. This is like kind of a weird but interesting time to look at deals.
Opportunity.
But with a lot of opportunity. And so it's not necessarily, kind of going back to my question, it's not necessarily you're looking at these specific metros. I know you're looking landlord friendly, looking at the Sun Belt, lower on insurance, high growth markets, but sometimes it's just done off deal capitalization. If there's a way you can get into that larger deal, you'll go into a Rogers, Arkansas or something.
Yeah.
You guys,
I mean, like, I think so, but like primarily first is the property has to make sense. I feel like if the property makes sense with high interest rate, then it's going to make sense as rate drops. For example, the build to rent, it's a construction loan. So construction loans are variable, right? So when we underwrote it, I think we underwrote it where we would pay like almost 10+% interest. So if the deal pencils out at that point, anything as it starts coming down, we're in a position in the market where if rate goes up, it's very temporary. It's not gonna be like a shot up like 11 times straight, right? So we're in a position where we're probably at the top and we're just gonna benefit from the downside. So anything we underwrite now, if it makes sense in this horrible interest rate environment, it only is going to get better. So I would pay more attention to the specific deals if I feel like it makes sense, because there are deals that are assumable, but they're also going to price that into the value of the property.
The value of it, right? And that's what I was wondering. Like, you have this great construction HUD multifamily ground up loan that's probably $180,000 for the median income, helps. It's Class A property. It's brand new, like you said. I think 2 years old at the time. 38 years are still left on the note. So they want the highest amount that they can get because it's cash flowing great at a 3% rate.
Well, in this specific case, HUD loans takes forever. So I think they price it okay. I don't think they price it super high because she wanted to sell. So like sometimes developers and operators are two different personalities.
Totally.
And so they want out, they want their cash, and they want to go deploy it somewhere else, where we want to stabilize and then maximize it for a little bit longer. So the personality and disposition of someone who builds and someone who holds, sometimes it's not the same. In this case, it was a developer and a billionaire. She helped fund it, and she lives behind our apartment even now, in one of the golf course community behind us. So, and her daughter has like a gallery in our property even today. So, essentially, it's a scenario where like look at the property first,
and then like for people who also are partners, like because we also bring in partners, and then they get access to this type of deal because they wouldn't have otherwise know about this deal if they didn't partner with us.
Right. What kind of deals do you guys have on the books coming up? I'm ready to invest. You've got me.
We're right now. We're looking to buy anything that's interesting. We're aggressively underwriting. We really desperately need to buy.
So for us, like we understood like what the type of playbook that we used to do, it probably won't work, and that's why we have been doing a lot more of ground up development, because like Palm said, turning dirt into the entire neighborhood, that's one of the way that we see we can add massive value to our partners, right? To the people who invest with us.
But right now we're also doing private credit that we mentioned. We have a fund that now lends to some multifamily properties, but we're opportunistic. So we're not gonna go away from our core bread and butter of buying apartments at the right value, but we're also gonna find better placement for the dollar our investor are placing as well. So anything that has good yield, good risk-adjusted returns, we're also looking to place it.
Because you said you're in multifamily private credit, and then you're focusing just on right partnerships, and that's what I had written down a little while ago. Tell us a little bit about private credit and how that's working and how that's vertically integrated into your business, because I think it goes hand in hand, right? You're looking into underwriting, and then you're underwriting to other deals. It's connecting you to other partners, allowing you to get into other deals, and it kind of snowballs.
Yeah, I think
well, here's the thing, like we actually have more money than we have deals. So we have a strong also like people who want to deploy capital with us. So for us, that's what we always looking to scale into different type of asset class as well. And one of them is private credit, because hey, we're on the side of this to put it together a deal. So the equity side, we're like, okay, how do we become our lender? Because our lenders have given us a lot of challenges. We're like, we want to be you.
There in some instances, like, you know, yield's important. So right now the yield is pretty good for our investors. Some investors want predictable cash flow. So then a private credit fund may make sense, where you get like debt fund where they get like consistent monthly distribution. Some people want to invest.
What does that distribution look like?
What was that?
What does that distribution look like?
It depends.
Monthly.
Basically monthly distributions, and it depends on the fund that they're in. It can be like high single digits, or low double digits, somewhere around there. So they're getting that predictable cash flow in a given period of time, and that's why we want, like Nan said, there's more money available than deals that we can buy for single families. So we want to address the need that some people want to have that. So we're trying to meet them where they need to.
And also we have capital partner who wants to learn what we do. So we bring them in as our like kind of junior partners, and they just get to work with us closely and doing deals with us.
That's awesome.
I love it.
If someone wants to go from earned income to owned income, what's their first step?
Well, you can come learn some stuff from us through our social media, the Kitti Sisters, KIT.
My next question was going to be, tell us everywhere we can find you. And, learn about
So if you want to see what scaling own income actually look like, go to scalingownIncome.com/roadmap. That is scalingownIncome.com/roadmap to get our free scaling own income roadmap. Or you can find us everywhere, the Kitti Sister. You can find us at the Kitti Sisters on YouTube, social media, and online.
Yeah, everywhere.
Everywhere. Now I'm definitely going to go to the YouTube channel, hit that subscribe button so I can be following you guys and learn more from you. Because like I said, this was great. I've definitely learned a whole lot. I know Will's is probably thinking the same lines with me, that we got to find a bigger parcel of land so we can do some ground up development in Northwest Florida with you guys.
Yeah.
Because like I said, we'd love to do what you're doing over there in Dallas, over here in this Pensacola market. What do you think, Will?
Yeah,
big time. I'm so curious on just learning more. I took like 10 pages of notes. Thanks again so much for everything.
I want to see those notes.
Yeah, I'm just like writing infinitely over here because there's so much, and like ending it on private credit, on like becoming your own lender is like. That's such a cliffhanger, because I'm like, oh man, now my mind's racing.
There's a whole other episode there.
It's a whole nother thing that I want to learn about.
Yeah.
But yes, scalingownIncome.com, the Kitti Sisters, amazing episode. Is there anything else that you guys want the listeners to know, or to know about you, or where to find you, or what to do next?
Or anything that we could do, or any of our listeners could do to help you?
Yeah.
Oh, I mean, like, I think for us, we want to see people actually transition from earned to own income. And the biggest thing is two things. One is always focus on being part of a watermelon and not be like have a closed mind and think you have to own the whole grape. I think like that's a really, really important point, especially when you're thinking about like small things, like partner with the right people, your wealth is gonna grow faster. And second is, do not let the dollar amount scare you. Get educated, have the right partnership, and you can buy and scale infinitely. Don't let just the tech people have become billionaires. Like if you see like the wealth is like durable wealth is in real estate that stands the test of time. So go do your thing and then like let us know how it goes.
I love it. I love it. Well, I can't thank you guys enough. This was so fun. I could probably stay on for another 2 hours asking you guys questions, but I know you guys are super busy. Thank you guys so much for giving us some of your time, dropping so much knowledge. I know the listeners are super thankful. I'm super thankful. Sam, I know is super thankful. So, yeah, just big shout out. If you guys need any building materials, definitely come to me. I can broker directly to your job sites in Dallas. So,
Okay.
yeah. And if anyone locally needs help, if you guys are looking for some good snacks and good dinners and lunches, make sure you guys go to Clean Eats, your local Clean Eats, or get meals shipped directly to your door. Thankful to all of our sponsors and everyone that allow us to do these fun things and get to meet incredible individuals like yourself and just learn so much, who know a million times more than we do. And this was just an amazing episode. So thanks so much.
This is one of those episodes where Will and I realize we're not doing enough.
I'm not doing anything. Yep. Not doing anything.
We appreciate you. If we appreciate you, you little ladies making us feel small. And you know,
I need that. You need to send me that when you said that.
Will and I are both 6'3", so just let you know.
Oh my God. We're like really like this.
You literally big boys.
Way bigger than us. We aspire to be on your level. Thank you so much for giving us your time today. Nancy, go throw a Palmy in that group chat so that way we can all be connected on through text message as well. And like I said, if we can help you guys in the future, let us know, and we definitely hope we can do a deal with you guys eventually too.
That's awesome. Thank you for having us. It was really fun.
Yeah, it was a lot of fun. Thank you.
Appreciate everyone for tuning in to this week's episode of the Elite Real Estate Podcast, and we can't wait to see y'all next week. Thank you for listening.
Thank you.
Sweet.